All right, well, welcome. And what we want to talk about today in this series of videos is start talking about long-term liabilities. And, um, the first thing we want to talk about is why do companies issue long-term liabilities, financing liabilities, really, um, such as bonds and notes payable. And we want to talk about the characteristics of bonds payable and compute the issue price for a bond, and then also be able to record interest amortizing the bond discount and premium. And then once that's done, we want to be able to extinguish a financial liability, understand bonds that have equity characteristics or convertible bonds, and then we're going to talk about accounting for long-term notes payable and the disclosure of long-term financial liabilities, and then understand troubled debt restructuring. That's going to be in the appendix. So remember, these are financing liabilities, and the big ones are going to be bonds payable and notes payable. So just kind of look at this. Here's Starbucks balance sheet, and we have our assets section, we have our liabilities, and what we see here is we see long-term debt way at the bottom, and it shows up at the 2012 balance sheet at $549.6 million, and then $549.5 million for the previous year. And so that's really what we want to think about, is just the accounting for this. And so, when we think about where this is going to show up, here's the cash flow statement. And remember, in Chapter 13, when we were the purchaser of long-term bonds, debt securities, right, that went up in the investing activities. When we're the issuer of debt securities, when we're issuing bonds or notes payable, that's going to be a financing activity, right? And so when we sell bonds or notes payable, or when we repurchase those are going to be financing activities. So that's when we have a transaction between the company and our creditors. It will show up as a financing activity. When we're the ones who's purchasing the debt securities, that's an investing activity. And so here's Starbucks footnotes with respect to long-term debt. And when we see this, it says in August 2007 we issued $550 million. Remember, that debt was on the books last balance sheet date at $549.6 million. So it was issued at a discount. And they tell us that it's 6.25% senior notes. They're due in August 2017, so it must have been a 10-year debt issuance. And interest is payable semi-annually. So remember, we have to always adjust the stated interest rate. So the stated interest rate was 3.125%. And it's due on February 15th and August 15th of each year. So, if we think about this, it probably pays interest about, I guess it would be $17 million, $17 million per period. And it says as of September 30th, 2012, the last balance sheet, we are in compliance with certain covenants which limit future liens and sales and leaseback transactions on certain material properties. So those covenants are in place in order to protect the lenders of the money, the creditors, so that they don't, Starbucks doesn't do anything that would jeopardize the return of that money to the creditors. And they tell us that record on the consolidated balance sheet, there's the 549.6. Now, in addition to that, anytime we have these long-term debts, we're also going to have to worry about interest expense. And they tell us interest expense net of interest capitalized. So remember, we did interest capitalization back in Intermediate 1 with plant, property, and equipment. And we talked about those cases when you can capitalize interest when it's a self-constructed project, and all the things that are going to be, there's money expanded, project is in place, and they tell us that interest expense was $32.7 million in 2012, and $3.2 million was capitalized as part of an asset. So the total amount of interest paid was $35.9 million. $32.7 million shows up as interest expense. $3.2 million was capitalized as part of an asset. So the big question is, why do companies issue debt versus equity? Well, and we kind of think about this, you know, for a lot of small firms and some medium-sized firms, it, it just may be easier to issue debt versus equity. So if you're trying to raise money, the reason debt might be easier to raise is because it's normally backed by collateral, such as a building or machinery, so that if the company does not do well, that those creditors can attach to the collateral and get some of their money back. With equity holders, right, there's a lot of risk, a lot more risk. Debt financing normally has a lower cost of capital than equity, right? So for numerous reasons, because it's a little bit less risky, it usually has, it's easier to, it has a lower cost of funds than equity and issuance. Debt also has a tax advantage. Remember that interest expense is tax deductible, whereas dividends paid are not tax deductible. Another big advantage of debt is that it does not carry voting rights in comparison to equity holders. So, you know, for a company that wants to protect and not dilute its ownership, it may issue debt because it does not want people buying up new equity and voting against their corporate policies. And then, you know, when we think about the big advantage here, we think about financial leverage. And when we think about financial leverage, we're thinking about the amount of debt liabilities versus equity. So when we think about two companies here, if these were our assets, liabilities, and shareholders' equity, imagine company one has $100 of assets, they have $90 of liabilities and $10 of equity. And company two has $100 of assets and they have $10 of liabilities and $90 of equity. And we think about those two companies, this company is highly levered versus company two, which is much less levered. And so we think about what is the advantage to that. Well, the real advantage to that is that as you become more levered, because debt has a fixed cost of financing, no matter how well the company does, it's only going to get their return based on the stated interest rate. And so we think about if this company has a return on assets of 30%, well, the debt holders still only get the stated interest rate as their return. The balance goes to the shareholders of the firm. And so with a highly levered firm, you're able to get more assets with less investment by the owners. And if those assets are very profitable, then you're going to get a higher return. And so one thing, make sure you look at that opener for the chapter, and we talk about, you know, the three companies and, you know, one that's very low, highly levered versus companies that don't have as much leverage, and look at the advantage that as you become more highly levered, as long as your return on assets is greater than your cost of borrowing, you're going to become have much higher return on equity. All right, so when we think about long-term liabilities, right, just remember that, you know, the definition of liability is a probable future sacrifice of economic benefits arising from an obligation of a particular entity to transfer assets or provide services to others as a result of past transactions. So remember, big key things here is consists of present obligations not payable within 1 year. So a long-term liability is going to be payable over a longer time period. And the other big thing about, you know, long-term liabilities, as we talked about those voting rights, long-term creditors have no say in management policies and only receive their stated interest payment regardless of the level of the company's earnings. Now, that's not to say that, you know, if a company's highly levered and somebody owns all the bonds, they're going to have a say in management policy. But in a normal case where a company just has debt, normally they would not have a say in the company policy. Only when that debt becomes really burdensome or really a large part of the capital structure. So most long-term debt is in the form of bonds as opposed to notes payable, simply because if companies are going to try to raise a lot of money, usually bonds are going to be able to be traded in the marketplace, and then, right, they'll be able to sell it to numerous different parties. Notes payable are normally just between a company and one other party. So, if you're going to raise a lot of money, it would be in the form of bonds payable as opposed to notes payable. But, a company like Starbucks, they have a relationship with a financial institution. They can still raise $550 million. So, in that case. Now, the other thing, when we start thinking about the features, so when we start thinking about these features of long-term bonds, the big question, are they secured versus unsecured? So is the debt agreement backed by the borrower's assets? So with a debenture bond, there's no real assets backing the debt. This is simply the good faith of the borrower. And so think about a company like Starbucks or IBM or whoever. They're able to do this simply because, right, they're financially successful. They have a lot of assets. Doesn't look like they're going to go bankrupt very soon. And so they can just borrow based on their reputation and faith. Now, other companies, right, issue mortgage bonds, and those are backed by specific property of the company. So it might be a building, it might be equipment, it might be something else. But mortgage bonds are secured, and debenture bonds are unsecured. The other feature of a long-term bonds are term bonds versus serial. And with that, the big issue is, when does the principal get paid back? And with a term bond, the principal gets paid back at the very end at maturity. And with a serial bond, a portion of the principal is going to be paid back on specific dates. So, with a serial bond, for example, imagine that it's a $10 million serial bond and it's 5 years. You might pay back $2 million each period until, right, that whole $10 million is paid off. With a term bond, the $10 million would be paid off right at the maturity. Now, why would a lender want to do term versus serial? Well, a serial bond is less risky. What we're going to be doing is we're just going to be dealing with term bonds. And, it's pretty straightforward to kind of take care of a serial bond, but we're just going to do term bonds. Interest-bearing versus a deep discount, or some people would call them a zero coupon. So interest-bearing is the normal case where the stated rate is greater than zero. Deep discount or zero coupon is where the stated rate is zero. That doesn't mean the effective rate is zero, but, right, the stated rate on those bonds are zero, and that's going to result in a deep discount at the time of issuance. Other issues that come up are, does the bond have a callable feature? And with a callable feature, right, the bonds can be called back to the issuer at the issuer's request, right? So that means the issuer can get those bonds redeemed whenever they want. With a convertible bond, the bonds can be converted into equity securities at the holder's request. All right, so we want to talk about term bonds, and we're just going to talk about this from the borrower's perspective, right, the debtor's perspective. And what's happening here is the issuing company receives a sum of money today and obligates itself, obviously a liability, to make periodic coupon payments over the life of the bond, as well as a lump sum payment equal to the bond's face value at maturity. So this is, a term bond. And so how do we price that? So because the bond entitles the investor to receive a set of fixed payments, the coupon interest payments plus the face value, the bond is going to be priced in the bond market at the present value of the discounted cash flows based on the market rate of interest. And so, right, if we think about it, imagine that's a $10 million, 5-year, semi-annual bond payable, and stated rate is 8%, and the effective rate here is 9%. What would be the price of that? Well, if we kind of draw a timeline here, here's 1 year, 2 years, 3 years, 4 years, 5 years, right? And we think about those semi-annual payments. There's going to be 10 payments, and the payments are going to be, well, 8% staid rate, but we divide by 2 because it's semi-annual, 4% times $10 million, right? So 10 million times 0.04, we're going to have $400,000 of payments each period, all the way through the life of this bond, plus, right, $10 million at the very end. And so what will this bond sell? Well, if the effective rate in the economy is 9% for this level of risk, will these bonds sell at a discount or a premium? Well, if everyone else is paying 9% and our bonds pay 8%, it looks like these bonds would sell at a discount. So let's just kind of do the financial calculator here. So N equals 10. The interest rate per year equals 4.5. The payment, right, and we're going to be making payments. So when we do this for Chapter 14 as the creditor, right, minus 400,000. And then the future value is negative 10 million. And so when we do this, we get a present value of 9,604,364. So the bonds sell at a discount. So when the effective rate is greater than the staid rate, bonds sell at a discount. When the staid rate is greater than the effective rate, bonds sell at a premium. And so just remember, right, the discount premium represents the difference between the selling price of the bond and the face value of the bond. So for our bond here, right, the face value was 10 million, and our initial selling price was 9,604,364. And so we had an initial discount of 395,636. I'll just round it here. And that represents an upfront pricing differential in order to equate the company's cost of borrowing with the market rate of interest. So the cost of debt is actually the market rate of interest, right? Just because they put an 8% staid rate on there doesn't mean that they can borrow at 8% when everyone else in the economy is borrowing at 9%. So that discount and premium is going to be amortized to interest expense over the life of the bond. So we'll take that 395 and we'll amortize it to interest expense over the life of the bond. And so in this case, right, let me just add a little slide here. Right, we have cash, 9,604,364, I think it was. We have bond payable, 10 million. And we have a discount on bonds payable of 395, 636. And right, that's our initial entry. And on that first interest date, we're going to have interest expense. And right, we're doing the effective interest method, and then we'll talk about the straight line method. We're going to pay cash, and we talked about the cash as the 0.04 times $10 million, $400,000, and our initial interest expense is, right, effective rate times carrying value. Well, the initial carrying value is the 9,604,364 times 0.045, 432,196, and doing some rounding there. And right, that bond discount is going to be amortized here, or discount, I should use the same term, sorry about that. Discount on bonds payable. And that would be 32,196. And that's our amortization of the bond discounted premium. So now, well, one thing to recognize here is that with long-term financing liabilities, we use discounts and premium accounts. So we're going to have those. We didn't do that with held to maturity or available for sale or trading securities, right? So we're going to have the bond payable for the $10 million. And so the bond payable will always stay on the books at the principal amount, and then we'll have that discount on bonds payable, and that started out at $395,636. And together those equal the carrying value of the debt. So a credit plus a debit, they net out to the initial carrying value of $9,604,364. And then we're going to be amortizing this, 32,196. And as we amortize that, that will drop to 0. All right. So, right, should be able to do this given what we did in chapter 13, but just good to reflect and make sure we can do this. Now, last couple issues before we stop this video, right? Incidental costs of issuing bonds. We treat that as a deferred expense and amortize the costs over the life of the bond. So any bond issuance cost, if we have to pay lawyers or we have to pay accountants, we debit bond issue costs and credit cash, and that bond issue cost is going to be amortized to expense over the lifetime of the bond. All right, so I'm going to stop here, and we'll come back and we'll do some problems and make sure that we can do everything we need to do for bonds.